As interest rates fall amid the slowdown in global economic growth, one key question on investors' minds and pretty much everybody's minds is, what should they do with their money in this low interest rate environment?
The year is fast drawing to a close. I'm sure many of you will only be too glad to shake off what must have been one of the most traumatic years in history and are looking forward to a better year ahead. Given these uncertainties, interest rates are expected to remain lower for longer. Even if a recovery takes place in 2021, central banks are unlikely to raise interest rates, given that growth are still below pre-pandemic levels. In this environment, when rates are close to zero and may even turn negative, how do you grow your investments?
In aggregate, we do think stimulus is going to remain. We think central banks will continue to be accommodative. You may see some more fiscal stimulus, but the size of that may not be the same size that we saw earlier in the year, as you've seen a decent recovery across consumers and companies. Generally, market participants have gotten comfortable with the idea that we're in this world. And so the bar for getting, say, another euphoric rise in asset prices around more stimulus is probably not going to happen. But we ultimately think it helps support markets and maybe provides a little bit of a backstop that, should we see some of the volatility creep higher because there's rising virus cases, we know that, central banks and governments are doing their part to try to support the recovery here, which is maybe, again, not for someone that's thinking about markets in the next month, but if I'm thinking about this over a medium-term basis, that's probably the most important takeaway here, is that we don't think the carpet's going to get pulled out from under investors here because of we think things are going to remain accommodative. Investors shouldn't think about abandoning deposits and government bonds and some of those safe haven assets that they have, especially the retirees of the world. But if you're thinking about solving for a longer term investing time horizon and doing that with things like deposits and cash, that's a really challenging proposition, just given the level of interest rates. And so we think investors are better served taking a little bit more risk, but doing it in a diversified way. That maybe means not buying single asset class exposures, but maybe doing it through multi-asset is a sensible approach where you could achieve better income and also get some risk management because you are taking diversification. We think equity income or income from stocks is a necessary alternative to what's available in bond markets. And that should provide support to some of the areas that can provide cash flow to investors through equity markets. And then the last point I would make on this is, stocks are a little bit different here. You don't necessarily want to buy the highest yielding stock. That's not always the best proposition here. Sometimes you're better off finding one that provides a reasonable dividend that can be sustainable and they can have the potential to grow that dividend. That's maybe a better proposition than finding a stock that yields 5% today. And so investors should be thinking about that don't just go for the highest yield. From a return and growth of income standpoint, you may be better served actually finding areas that provide kind of decent income, but have the ability to sustain that income and grow it over the course of time, especially if you have a long time horizon.